Hey guys, buckle up. Markets just had one of their worst two-day drops in recent history. And it's not just a blip. We're looking at something way bigger. The S&P 500 tanked 10.5% over 2 days. The Nasdaq? Down 11.8%. That's not just another pullback, it's historic. We're talking drops on the level of Black Monday in 1987, the COVID crash in March 2020, and the global financial crisis in 2008. And for the Nasdaq, the last time it fell this hard was back in April 2000, when the dot-com bubble burst. So, what just happened? Well, it starts with tariffs. President Trump rolled out a major wave of reciprocal tariffs, and it's already blowing up into a full-blown global trade war. Countries are firing back. China's already slapped on new tariffs of their own, and the fallout is hitting global supply chains and trade volumes hard. This isn't just political drama anymore. It's hitting the real economy. And here's where it gets serious. Economists are now officially forecasting a recession. Real GDP, which was expected to grow 1.3% this year, that's now been slashed to negative 0.3%. Yep, the U.S. economy is expected to shrink. Why? Simple math. Tariffs mean higher prices. Higher prices eat into real income. And when people feel poorer, they spend less. Consumer spending slows down, and the entire economy starts to feel it. To make things worse, inflation is staying hot. Core PCE, the Fed's go-to inflation gauge, is now expected to hit 4.4% this year, up 1.4 points from previous estimates. So now we've got slower growth and higher inflation. Stagflation, anyone? And let's not forget about the labor market. Unemployment is expected to climb to 5.3% by year-end. That's a big jump from where we are now, and it means weaker hiring, slower wage growth, and a lot more pressure on households. So what's the Fed gonna do? Are they gonna fight inflation or support growth? Right now, the Fed's walking a tightrope. Markets still expect the first rate cut in June. But now economists are saying the Fed might go even harder, like a rate cut at every meeting from June through January. That would bring the Fed funds rate down to 3.0%. But honestly, there's still a risk that the Fed waits longer, especially if inflation doesn't cool fast enough. Let's dig deeper into how all this is hitting the economy. First, prices are going up. But unlike the post-pandemic spike where incomes were booming, this time nominal wage growth is softening. So people are feeling the pinch more. And unlike in 2021 or 2022, they're not diving into their savings to keep spending. With all this uncertainty, consumers are pulling back. Second, exports are at risk too. China's retaliatory tariffs are already in place, and other countries might follow. That's a hit to U.S. manufacturing and overall trade. Third, investment spending's gonna feel it too. Businesses don't like uncertainty, especially around trade policy. And that uncertainty makes companies hesitant to spend on CapEx. We haven't seen a total freeze yet, but it's coming. The weakest months? Likely right in the middle of the year. GDP could contract in both Q3 and Q4. Q2 might look okay on the surface. There's some leftover momentum and inventory quirks. But don't get fooled. The real damage is likely coming in the back half of the year. Now here's an interesting political twist. Trump's approval rating has dropped to the lowest point since his second term started. But guess what? Back in 2017, his ratings were even worse, and then he bounced back. How? The tax cuts. In December 2017, he signed the big tax reform bill, and his numbers started turning around. So, are we seeing the same playbook here? Some folks think these tariffs might just be phase one, a setup for a new wave of tax cuts. Trump's been talking about a $4.5 trillion tax cut plan over the next 10 years. Tariffs could bring in $600 billion a year, so maybe this is how he's setting the table. Now let's bring it back to markets. Despite all the chaos, global liquidity is actually rising. And corporate earnings for S&P 500 companies? Still hitting all-time highs. But here's the catch. Valuations have collapsed. The forward PER on the S&P 500 dropped 18% in just 3 months. That's one of the biggest valuation hits we've seen since 2000. So yeah, the market's already pricing in slower growth and weaker earnings. So what should you be watching? 2 things. First, a pivot from Trump. If he starts signaling tax cuts, markets could find a reason to bounce. Second, the Fed. If Powell and Comey confirm they're ready to cut, especially in June, that could be the trigger for a turnaround. In the meantime, keep an eye on sectors with strong sales growth. After past crises, 2008, 2020, even 2022, the best performing stocks came from industries that led in revenue recovery. For 2025, U.S. semiconductors, software, and healthcare equipment are looking strong on that front. All right, that's your update. A whole lot of risk, a ton of moving parts, and some big decisions ahead, both for policymakers and investors. If you found this helpful, drop a like, leave a comment with your thoughts, and hit that subscribe button so you don't miss what comes next. Stay sharp, stay informed, and I'll see you in the next one.